Hello and welcome to video lectures on IGNOU MBA. This is course number 4, Accounting and Finance for Managers. In this course, at present we are seeing unit number 3 in block number 1. Unit 3, Accounting Information and its Applications. In this unit we are going to see the following topics: nature of accounting information, major purposes of accounting information, role of information in the control process, the uses of earnings information, and uses of information contained in the balance sheet. So this unit is dealing about accounting information, its nature, purpose, role, usefulness, and and uses of information in the balance sheet. Okay, let's begin with the introduction. What is accounting information? When we talk about accounting information, we generally look at it in a broader sense to encompass information processing for both internal and external uses. Information which serves the purpose of external users is called financial accounting, whereas the information which serves the purpose of internal users is called managerial accounting. Let us see the purposes of accounting information. There are three main usefulness of accounting information. They are scorekeeping, attention directing, and problem solving. What is meant by scorekeeping usefulness of accounting information? Scorekeeping means this accounting information asks the questions like how is the business doing, whether it is doing good or bad, what does it mean doing good, is it profit earning good, is it profit sufficient, like this. These questions from the accounting information is called score keeping aspect of the accounting information. Okay, in order to answer this question, actual data has to be compared with certain standards or norms or benchmarks. So an accountant has to provide precise information which is useful for score keeping. You can also have there is this activity: complete 5 questions. 2 are already given below, which will lead to the assessment of financial health of a business organization. 2 questions were asked here. This activity is asking us to ask 3 more questions, which asks the financial health of a business organization. What is the first question asked here? How much profit was made by the organization in the preceding accounting year? That is the first question. Second question, does the organization have sufficient funds to meet its day-to-day expenditures? This is asking about working capital. Oh, I have written one more question, 3 more questions like this. Whether debt is more or equity is more? So by taking the debt to equity ratio, we can see the financial health of the organization. How many creditors are there and what is the amount to be paid? This talks about the liquidity of the business. How much provisions were made in this year? So by looking at the provisions, we can see the actual position of the profits. All these questions look at the health of the business organization, financial health. Okay, the second aspect of accounting information is attention directing. Accounting information can help in attention directing also. Okay, what is this attention directing means? It is nothing but the process of giving a signal to the user that a decision needs to be taken. Once you see the information, you have to take a decision. For example, a report from an accountant comparing the actual performance against the budget is called scorekeeping. Whereas if the information is in the hands of a decision maker, then it helps in decision making, attention directing information. This would enable him to immediately focus his attention on the deviations or variances from the budgets or the plans. Therefore, a series of actions will be triggered by taking decisions, like taking remedial actions, modifications. All these things can be taken by the decision maker. Okay, and thus accounting information helps in decision making. Next, problem solving. There are many problems which accounting information could highlight and provide for their possible solutions, such as make or buy decisions with respect to components, parts or products, acquisitions, mergers, buying or selling. It is very direct. Directly, the information is helping us in solving problems. Okay, now let us summarize the purposes of accounting information. Accounting in its scorecard role accumulates data and enables interested persons, both the internal and external persons, to understand and take stock of the organization's performance. In its attention directing role, accounting information by way of reporting and analyzing the data focuses a manager's attention on operational deficiencies or weaknesses or threats and opportunities. In this role, accounting complements day-to-day operational planning and controlling activities. In its problem-solving role, accounting enables quantification of the different alternative solutions, their relative merits and demerits. Therefore, the three aspects of accounting information are scorekeeping, attention directing, and problem solving. Fill in the blanks questions are there here. Financial accounting deals with reporting information for dash uses, and dash deals with reporting information for managerial uses. We have seen already. External users, it is financial accounting. For internal users or for managers, it is managerial accounting. Accounting information addresses itself to three distinct activities. The usefulness of accounting information for scorekeeping, for attention directing, and for problem solving. Scorekeeping activity involves two functions. First, keeping record of actual data on performance and comparing the data with the standards. Right. Attention directing information triggers the need for taking dash in the recipient's mind for taking decision. That is the attention directing activity. Problem solving in accounting involves provision of dash to enable managers to find dash problems. Provision for information which enables managers to find solutions to the problems. Right? Third part is accounting and control in the organization. Accounting or accounting information is closely connected with controlling operations in the business. You can see this diagram. There are inputs to the accounting system. There is an operating system or accounting processes, accounting methods, generally accepted accounting principles. All those things are there. They are analyzed, evaluated, and outputs are generated, which is reports, financial statements. There is a technical system which acts as a controller in this analyzing. Therefore, accounting helps in controlling the operations of the business. Now, let us see an example which shows how accounting helps in decision making and controlling. Let us try to define a problem in a hypothetical setting. I will read out the example here. It will be useful for you in the examination and also in the understanding of the subject here. You are confronted with a problem that the profit of your firm is decreasing. Now, falling profit may be due to many reasons. The first thing that you would like to do is to identify the problem more precisely before you set about solving it. Let us examine how accounting information could be helpful in identifying a problem of this nature. Here is a summary of profit and loss account of some hypothetical firm. There is this data. In the year 2002, this is the sales figure. This is the total expenses figure. Same thing was given for the year 2003 also. From the above, if you see that, it is clear that in 1 year, the profit has declined by 100 rupees. In the year profit was 300, and in the year 2003, profit reduced to 200, which means it declined by rupees 100. An examination of the profit and loss account would show that sales have remained same and all expenses also remained same except the cost of goods. You see here, in the year 2002 and in the year 2003, the sales figure is 1000, depreciation is 200, other operating expenses is also same, it has not changed, whereas the cost of goods increased from 400 to 500. So decrease in profits during the period has come about. So the what we can understand from this is the profits are decreased because overall cost of the goods sold is increased by 100. Okay. In this way, the earnings information helps in identifying a problem. Suppose if the same firm has 3 products, as we have already said earlier, P1, P2 and P3, how the trifurcation of the information helps in identifying which product is giving the actual problem. Okay. You see here, sales of product P1 is 300, cost of sales is 150. For P2 also same. For P3 it is 400 and 100. Cost of the sales is only 100. See, total sales is 1000. Total cost of sales is 400. As we have seen already here, it is given 400. Total cost of goods is 400. Here also total cost of 400. But it is 150 for P1, 150 for P2 and 100 for P3. Okay. If we see the same figures in the year 2003, sales for product P1 increased. Sales for product P2 also increased, whereas sales for product P3 decreased, but the cost of the sales remained the same. Okay, when sales increased for products P1 and P2, the cost of sales also increased. It is obvious, I mean, they are maintaining same ratio. Whereas for product P3, when the sales are decreased and the cost of the sales remained same, which means cost of sales in relation to the sales has been doubled. Therefore, there is a problem with the product P3. Okay, in this way, the earnings information and the trifurcation of products helps us in identifying the problems. Okay, next topic is profit and cash balance distinguished. Okay, good. How do we evaluate the results of a firm? There are many ways to evaluate, but the most common ways are looking at the worth of the business and how much it is earning. These two aspects give us how profitable the firm is. Okay, now we will illustrate this through an example. There is an example given here. Through this example, we will be seeing different aspects of profit and loss account, and whether the cash balance is equivalent to the profit or not. Okay. Example: Shyam decided to start a small casting and machine shop. He undertakes job orders for castings. He hired a shop floor with a backyard, bought the necessary equipment, and hired a few workers. Shyam had very successful operation during the first year because he was engaged throughout the year. He tried to prepare his okay. The setting is like this: someone started a business. He hired workers. He hired a shop and ran the business successfully for 1 year. At the end of the year, he prepared the accounts and discovered what had happened to his business. Let's see what happened. He discovered that his collection from customers was 24,000 rupees and he had borrowed 30,000 rupees from the bank. Okay, so you can see the receipts of cash are like this. From bank, he borrowed 30,000. From collections, he got 24,000. Total 54,000. He had run down his savings substantially. Okay, what is next? He had spent 72,000 for running the business. How did he spend? And in what items he spent? Wages 12,000 rupees. Materials purchased 36,000 rupees. Payment of installment for equipment purchased. Installment 5,000 rupees. Electricity charges 1,000 rupees. Withdrawals for personal use, you underline this point. Withdrawals for personal use is 15,000 rupees. Other payments or miscellaneous payments 3,000 rupees. Put together all the payments is 72,000 rupees. There is an excess of payments over the total receipts by 18,000 rupees. Okay. From this, what we understood is he had run down his savings substantially. Okay. Cash is short of cash. Okay, that is the final gist of this statements of these figures. Shyam discussed the situation with his friend, who is a graduate student of management. He worked out Shyam's operating results for the period. Shyam's friend, with the help of another table, could convince Shyam that the situation is not very bad. Okay, how did it happen? You see. He made sales of 36,000 rupees. 1/3 of it is yet to be collected. In other words, on an average, 4 months sales remain uncollected. He has not yet received the cash for the sales that he has done. Okay, even though he purchased materials worth 36,000 rupees, he consumed only 1/2 of it for production and sales, which means material sufficient for another 1 year is still there as a stock. Next, Cash generation during the year was 54,000 rupees, whereas the need for payment amounted to 72,000 rupees. Put together all these things we'll see here. Collection from sales is 24,000. Sales yet to be collected means cash receivable is 12,000. Total is 36,000. Less cost of sales is 36,000, which actually incurred, and inventory, he has this stock still at his hand, so that 18,000. The net of this is 18,000. He has paid wages of 12,000, electricity 1,000, other expenses 3,000. Put together 34,000 is the total expenses. Therefore, total net profits is 36,000 minus 34,000. 2,000 rupees still profit is there. Here, what is happening is they are using the concept of revenue recognition, accrual basis of accounting. We'll see this. There is a fundamental difference in approach and utility of information contained in the two tables, which we have seen earlier. While table 1 looks at the problem purely from the viewpoint of cash, whether it is increased or decreased, whereas the table number 2 summarizes all the revenues and expenses which belong to the period of 1 year, irrespective of whether or not all the revenues have been realized in cash and whether or not all the expenses have been paid in cash. Okay, whether the cash is received or not, whether payments have been paid, actual cash is paid or not, irrespective of these things, yes, they have used this table number 2 used the revenues concept correctly. In fact, in doing so, we are making practical use of accrual concept as accrual concept, which I have said earlier, and principles of revenue recognition. Cash balance is therefore what we understood is whatever the cash at hand is not equivalent to the net profit. A business firm might have earned a profit and still be short of cash, and vice versa also can happen. Okay. The next topic is uses of earnings information. Earnings information is nothing but profit and loss account. From profit and loss account, what information can we get, or how it is useful, and for what it is useful. Okay, there are 4 aspects here. Earnings information is useful for measuring the accomplishments of the business, deciding how much can be withdrawn from the business without impairing the current level of operations, identify the problems, and determine the market value of the business. What is accomplishments? How it is useful in accomplishments, in seeing the accomplishments. Profit is an important indicator of the accomplishment of business. Okay. Other things remaining the same, higher the profits, greater is the accomplishment. In the above example, accomplishment of Shyam's enterprise can be summarized as follows. It has earned a net profit of rupees 2,000 during the year, which is given in table number 2 using the revenue concepts. At the same time, it should be seen from table number 1 that there is a severe cash constraint. Understandably, it was the startup situation which might have been the responsible for this cash constraint. Therefore, earnings information tells about the profits of the business, which says much about the accomplishments of the company. Now, appropriation decision. Appropriation means utilizing the money or withdrawing the money. An important question which owners of a business are often confronted is how much money can be withdrawn without impairing its current level of operations. A prudent management would not only like to maintain the capital or the present capability of the enterprise intact, but would also plan for future growth. The maximum amount that the owners can withdraw from business for their personal expenses should be limited to the net profit. Remember this, maximum the owners can withdraw should not go beyond the net profit. It should be limited to net profit after charging depreciation and all other losses in the course of the business operation. If there is any tax liability also, that should also be reduced. To that extent, net profits should be reduced, and therefore the remainder only should be used for appropriation, for withdrawal. If the business is having any plans for future growth also, then that amount should also be reduced from the net profits, and that remainder should be used for withdrawals. Okay, after charging depreciation and all other losses incurred, after reducing the tax liability if any, whatever is the remainder portion of net profits, only that amount has to be used for appropriation. Okay, This earnings information helps us in getting information about tax liability, depreciation, all those things. Problem identification using earnings data. Lower earnings may be on account of excessive cost of inputs, excessive expenditure on overheads, or lower margin of profit on sales or executive piling of inventories or other unanticipated losses. This is talking about the previous example. Why there are lower earnings in a business enterprise? There could be many reasons. There could be cost, higher cost of inputs, or there could be excessive expenditure. Okay, there are various causes like this. There are huge stock of inventories could be there. So in the previous example, we identified two problems even from the very limited data which you have, even from the very small example which you have seen. The inventory acquisition, the example, was not in tune with the production and sales. This has led to large amount of accumulated inventory is more, stock is more, it is not being utilized. I think it was 12,000 rupees, I think. 12,000 rupees unused stock is there. Inventory at the close 18,000 rupees. Okay, 18,000 rupees of unused stock is still lying. Okay, this is not in tune with the production and sales. This is not a prudent way of utilizing the inventory. Credit granted to customers shown by credit sales amounts to 4 months of sales. This shows either grant of credit on liberal terms or slow collection of receivables. Therefore, from the small information like this in the above example, this information helps in identifying the problems in the business. In this present example, we saw that inventories are huge and the granting of credit is not prudent. Next, the next aspect is determining the market value of a firm. Economic value of the firm is determined by the size and reliability of the stream of earnings, means future cash flows produced by the business, not future. The stream of cash flows produced by the business. Example on how to value a company's worth. We'll see here. I'll read out the example here. Let us attempt the valuation of a hypothetical firm, Bharat Kitchen Aids, which was incorporated as a company in 1998 by four non-resident young Indians to market a simple but revolutionary cooking gas lighter invented by one of its founders. In order to conserve its limited capital, the company opened its business in a rented premises with rupees 80,000 worth of equipment used mainly for research and development work. Arrangements were made with an established manufacturer to make the gas lighter under rigid supervision of one of the members of the young team. Because the gas lighter was able to meet long felt need, the company reported a modest profit in its very first year of operations. The four-man team was remarkably well balanced, combining talents in engineering research, marketing, and management. In the next 2 years, they developed three more appliances that were well received in the market. By 2003, the turnover had grown to about 1 crore and net profit amounted to rupees 14 lakhs. At this point, the total investment of the owners amounted to rupees 32 lakhs. Total equity. Annual earnings therefore represented an after-tax rate of return approximately 44% of the equity. 44% of their investment, 32 lakhs, is 14 lakhs. That is the annual earnings. The rate of return is 44%. The high return could be attributed to using the facilities of other manufacturers rather than building their own. The patents that the company registered and the scientific and managerial skills the team possessed. Okay. An interesting development then took place. A large manufacturer in the household goods sector wanted to acquire the company and offered the owners a very attractive price. The four owners wanted to consider the offer and make a decision, but asked for a few weeks of time to make up their mind. The owners knew that they had established a solid position in the industry and had no doubt that they would be able to maintain this position. They, however, felt the potential for future growth was limited. They drew very good salaries which would continue to enjoy even if they were to sell their business. To work out how much equity in the company was worth to them, they could take a decision, so that they could take a decision on the price offered, the four men started by forecasting the company's future profit cash flows. Now here, see, the summary is that someone started a company and their total equity was 32 lakh rupees. They are earning 14 lakh rupees every year, that is return on their investment, which is 44%. Now someone wanted to buy that business. Now, in order to value the worth of the firm, they are estimating the future cash flows and their present value. We'll see this to work out how much equity the company was worth to them, so that they could take a decision. Okay, they have started forecasting the company's future profits or cash flows. They believed that the net profit would continue to be around 14 lakh each year for the next 10 years. Means they assumed that every year they are going to earn a net profit of 14 lakh years for the next 10 years. Further, if they did not sell out in 2004, they could sell their interest in business. That is, they can sell their equity 19 years later at about 50 lakhs. Apart from this 14 lakhs every year, they also expected they can sell their business for 50 lakh rupees. Their investment, 32 lakh investment, can be sold at 50 lakh rupees after 19 years. In accordance with these estimates, the anticipated net earnings from continued ownership would be as follows. Okay, so earnings would be like this. They would get 14 lakhs every year, and at the end they would get 50 lakhs. This is their expectation. You know that the money has time value. You attach more value to an amount to be received now than the one to be received, say, a year or two later. Which means whatever the amount we are receiving today is more important than the amount that we are receiving tomorrow or 1 or 2 years later. Okay, we have to estimate the present value of the amount that which we are receiving 1 year or 2 years later. The process of reducing the future earnings to present values is known as discounting. For this purpose, a discounting rate is required. This discounting rate is the expected rate of return which satisfies the owners of the investment. Suppose the owners are expecting 14 lakh rupees every year. Today 14 lakhs is okay. They have the money with them. Next year also they are expecting 14 lakhs, but there is no guarantee. Therefore, it has to be discounted, which means if it is 14 lakhs tomorrow, what is its value today? We have to reduce that tomorrow's value to today's value by a factor, that is nothing but a percentage, that is called discounting rate. The owners in this case thought that the rate of 15% after taxes was a satisfactory return on investment for the type of the business they were engaged in, which means they want a discount rate of 15%. The question before them was how much anticipated earnings were worth presently at this rate. At 15% desired rate, they calculated the present value of stream of earnings of 14 lakhs a year for 10 years and for 15 lakhs at the end they were to receive. They found the present value was 82.62 lakhs, means 83 lakhs. For every year they are expecting 40 lakhs, and at the end they are expecting another 50 lakhs. Total, all these values are discounted at 15% of discount rate, and they estimated the present value to be 83 lakhs. Okay. However, in accordance with the concept of present value earning of 140 lakhs to be received over a period of 10 years and a lump sum of 50 lakhs to be received at the end of 10 years is a total of 190 lakhs must be considerably less than this amount. Okay. 10 years for 10 years 14 lakhs each, 140 lakhs plus 50 lakhs at the end is 190 lakhs. Total amount is 190 lakhs. It is okay, but that value today is 83 lakhs at the rate of 15% discounting rate. Under these assumptions, therefore, the owners would not accept an offer of any amount which is less than 80 lakhs. They wanted minimum 83 lakhs and above 83 lakhs, which is the present value of the business. Okay. However, if the owner feels that the company would continue to produce 14 lakhs a year indefinitely, they do not want to sell their equity also, then the infinite cash flows every year, 14 lakhs, 14 lakhs, 14 lakhs, then in that case they would they would be expecting the present value would be 93 lakhs at the discount rate of 15 percentage. Okay, in this way the cash flows, the expected discounted rate, all these things will help us in valuing the market capitalization or the capitalization of earnings, the value of the firm. The process of ascertaining the value of business with the help of earnings and a desired rate of return is known as capitalization earnings. Okay, so this is the usefulness of the profit and loss account or the earnings information. Now, use of balance sheet. The balance sheet is a summary of firm's assets and liabilities. Liabilities are also called as claims over the assets, including share capital and reserves at a defined moment in time. That is why it has been described as a snapshot or a still picture of the financial position of a business entity. It is also called as the position statement, which means at a particular moment of time, what are the assets, what are the liabilities of the company. That is balance sheet. Okay, shareholders. Shareholders are usually interested in regular income in the form of dividend and appreciation in the value of their shares. The retained earnings in the balance sheet of a company will show an impact on the market value of the shares. Okay? Shareholders usually have twin interests, an interest in receiving a regular income, which is dividend, and an interest in the appreciation of their investment shares. Trade creditors, how the balance sheet is useful for different stakeholders of a company like shareholders, trade creditors, long-term creditors, managers. Okay, the trade creditors are interested in the liquidity position, how easily or whenever they ask for money, whether the company will be in a position to pay their bills or not. The trade creditors are looking at the liquidity position of the company. From there, this information can be culled from the balance sheet. Long-term creditors who lent money to the company for long term are interested in the solvency and financial viability of the company. They see the debt to equity ratio. They want the company to service their debt. Service their debt means pay interest at regular intervals and repay the loan at the end of the term. Similarly, other interested parties like regulatory and developmental agencies of government, consumer and welfare organizations can derive much more useful information from the study of balance sheet. In this way, balance sheet is useful to many persons. There is this activity. It is a revision of what we have studied earlier. Mention four important uses of earnings information, right? So it measures the accomplishments like how much profit uh, was earned in a particular accounting year. Appropriation decision means how much can be withdrawn after the net profits, which is after deducting tax liability, deducting or putting aside some money for future growth also. How much can be withdrawn? What is the maximum amount? Identifying Bye bye.